Have you ever wondered how professional traders seem to predict market moves before they happen? What if you could spot hidden patterns in the chaos of price charts and align your trades with the big players in the market? Today, we're diving into a powerful yet often overlooked concept called candle range theory, a method that helps decode market behavior, boost your confidence, and dramatically improve your trading results. Whether you're new to trading or looking to sharpen your skills, this video will break down everything you need to know in plain, relatable terms. Let's get started. First, let's talk about the basics. Every candlestick on a chart tells a story. A single candle shows the battle between buyers and sellers during a specific time period. The top of the candle, the wick, represents the highest price reached, while the bottom shows the lowest. The thicker body between the open and closed prices tells us who won that battle. Green if buyers push prices up, red if sellers drove them down. But here's the twist. Candle range theory, CRT, looks beyond individual candles. Instead, it focuses on how groups of candles interact over time. Think of it like zooming out on a map. What looks like a single candle on a 1-hour chart is actually a series of smaller price movements visible on a 5-minute chart. By understanding these patterns, you can anticipate where prices might head next. Let's simplify this with an analogy. Imagine the market as a busy coffee shop. The accumulation phase. Early in the morning, the shop is quiet. Regulars trickle in, sipping their lattes while the staff preps for the rush. Prices stay steady. This is the calm before the storm. The manipulation phase. Suddenly, a tour bus parks outside. The baristas scramble to handle the crowd. Prices for coffee might spike briefly or dip if they're overwhelmed, triggering stop-loss orders or luring in impatient traders. The distribution phase. Once the rush dies down, the shop returns to normal. Prices stabilize again, but the smart traders who anticipated the chaos have already taken their profits. The market works the same way. Prices cycle through these three phases endlessly. Candle range theory helps you recognize which phase you're in and where things might go next. Here's where it gets exciting. Let's say you spot a large green candle on the 1-hour chart. To CRT traders, this isn't just a win for buyers. It's a range of battleground between buyers and sellers. When you zoom into a 15-minute chart, that single candle becomes a cluster of smaller candles. The high and low of the original candle act like invisible fences. If prices break past these levels, it signals a potential trend. For example, if the price sweeps below the low of the 1-hour candle, creating a long wick, but then bounces back up, it's like the market tested a support level and found buyers waiting. This manipulation phase often tricks traders into panic selling before the price reverses. CRT helps you see through this noise. 1. Accumulation, the quiet before the storm. This is where big players like institutions quietly build their positions. Prices move sideways, no big jumps or drops. Think of it as the market catching its breath. Key tip: if the Asian trading session, often a quieter time, shows sideways movement, expect bigger moves during the London or New York sessions. 2. Manipulation, the trap. Here, prices make sudden, sharp moves to shake out impatient traders. A classic example: prices briefly dip below a support level, triggering stop-loss orders, then reverse direction. CRT traders watch for these traps to enter trades. 3. Distribution, the profit-taking phase. After a big move, prices stabilize again as institutions sell their positions. This phase sets up the next cycle. Let's see this in action. On this 1-hour chart, a large red candle forms during the New York session. The next candle dips slightly below its low, manipulation, then reverses. CRT traders would see this as a signal to buy, anticipating a move back to the top of the original range. How to spot candle range patterns. Step 1. Identify key levels. Draw horizontal lines at the high and low of a significant candle, usually on a 1-hour or 4-hour chart. These levels act like magnets. Prices often return to test them. Step 2. Watch for sweeps and reversals. If prices break past a key level but quickly reverse, leaving a long wick, it's a sign of manipulation. Step 3. Confirm with multiple time frames. Use a 15-minute chart to fine-tune entries. Look for patterns like inside bars, small candles within the range, or strong bullish/bearish candles after a sweep. Pro tip: align your trades with major market sessions: Asian, London, New York. If London session prices sweep a level set during Asia, the New York session often follows through. Real trade examples. Example 1. Bullish reversal. On this 1-hour gold chart, a large bearish candle forms during the New York session. The next candle dips below its low, creating a long wick. This is the manipulation phase. Traders panic sell, but savvy buyers step in. Zooming into the 15-minute chart, we see a bullish reversal candle closing inside the original range. This is our signal. We place a buy order at the breakout point, set a stop loss below the wick, and target the top of the range. Example 2. Bearish continuation. Here's a classic trap. On the 4-hour chart, a bullish candle stalls at a key resistance level. The next candle spikes above it, tricking traders into buying, only to reverse sharply. Zooming into the 1-hour chart, we see a long wick above resistance, the distribution phase. Sellers swoop in. We enter short on the break below the candle's low, targeting the accumulation zone below. The result? A smooth drop, locking in profits as the cycle resets. Common mistakes to avoid. 1. Chasing the breakout. Don't jump in the second a level breaks. Wait for the sweep and reversal to confirm. 2. Ignoring time frames. A pattern on the 1-hour chart needs confirmation from the 15-minute. Mismatched time frames equals false signals. 3. Overcomplicating it. CRT works best when you stick to the rules. No need to add extra indicators. Putting it all together. 1. Find a range. Identify a large candle on a higher time frame. 2. Watch for manipulation. Look for false breakouts, long wicks on lower time frames. 3. Enter with confidence. Place your trade as price re-enters the range. 4. Set realistic targets. Aim for the opposite end of the range or key support/resistance levels. Final tip: practice this daily. Start with historical charts, then paper trade. Over time, you'll spot these patterns instinctively. Candle range theory isn't a magic crystal ball, it's a framework to understand market psychology. By focusing on how prices move between key levels, you'll start seeing opportunities others miss. Remember, even the pros lose trades. What matters is consistency, discipline, and continuous learning. If you found this helpful, hit that like button and subscribe for more strategies that simplify trading. Drop a comment below. What market do you want us to analyze next? Let's grow together as a community. Thanks for watching, and see you in the next video.